Okay, guys, now we're covering the last stock on our watch list that showed a little promise this weekend. We're at the weekend of 10/28 or October 28th of 2023. And now we are going to cover RCI Hospitality Holdings. And I have to say, I feel a little guilty today because I went through our other four stocks yesterday, and here we are on Sunday. I just got through coming from church. My wife is inside cleaning the house and blasting gospel music. And here I am talking about RCI Hospitality Holdings, which is a stock or a company that has a lot of holdings in what we would call adult entertainment clubs, is what they refer to them as. But what that really means is high class strip clubs and a few, what would we call them? I'm not sure if they're like sports bars or whatever. I haven't been to them, but they are sort of like tilted kilter or something like that, if for those who are familiar with it. So in any event, let's get into RCI Hospitality Holdings. The rest of the research you guys can do on your own time. I believe they're in the Miami area. But let's jump into them. RCI Hospitality Holdings. Over the previous 5 years, their earnings per share was at $2.15 in 2018, $2.10 in 2019. Now, in 2020, it was a negative earnings per share, meaning the company lost money that year. For those who remember, 2020 was the COVID lockdowns. The thing that's sort of strange about that is generally things that are more along the margins, things like strip clubs or junk food or things of that nature, tend to do well during bad times. But in this case, RCI Hospitality also did bad in 2020. 2021 they came back, and they came back strong. I guess people was ready to get to the strip club after it opened back up after COVID lockdown. So 2021 it jumped up to $3.37 a share, and it didn't retreat. $4.91 a share in 2022 kept going up. And now here we are in 2023. And our current earnings per share is $4.06. Remember, we still have 2 months left to this year. So we don't know if this is going to be the final earnings per share for this year or if it'll end the year a little higher. But in any event, our current earnings per share is $4.06. And our current PE ratio is 12. Let me just check that, because sometimes I leave the lower PE ratio, or, well, actually, that's the earnings per share. It's actually moved up a little. Yeah. Our current PE ratio is 13.07. At the time I analyzed this company, it was 12.85. But the price has moved up a little since that time. I left the old PE ratio that it was at when I analyzed it because I like to calculate how far it can go up, and I can calculate that accurately from the lowest PE ratio I find it at. So I didn't want to put the higher PE ratio. So let's look at where it's been in the last 5 years. In the previous 5 years, 2018, well, first let's look at the prices. The price went from $18 to 33. 2019, it went from 13 to 24. 2020, it went from 7 to 39, lower than the previous 2 years, but it ended up going higher than the previous 2 years. 2021, from 36 to 79, and from 2022, 47 to 95. And now it's at $53, but the PE ratio, notice, is higher than the low PE ratio in the 5 previous years. It was 8.41 in 2018, 6.65 in 2019. 2020 was a negative year, so we're not going to count that. But in 2021, it was 10.78. In 2022, it was 9.70. So this stock still has room to drop in order to get to the low PE, but it is possible that it could stop here at 12.85 and just move up for the rest of the year. But if it starts to move up a little, if you're in it, and it starts to drop, I would jump out. I wouldn't stick around too long to lose much money. In any event, let's look at let's look at where it could possibly drop to. First, let's look at where it could possibly drop to if the PE was to drop further. So let's say the PE was to drop to, I don't want to go all the way down to 2019 665, even though that's possible, but let's say it was just to drop to the second from the lowest. 2018's 8.41. So if I say 8.41 times the earnings per share, 4.06, this stock would drop from its current price of 53.06 to $34.14 if it was to drop to 2018's low PE ratio, which is 8.41. We don't want to see what it'll drop to if it drops to 2019's, which is 6.65. But having said that, let's see what would happen if it moved up from where it is right now, or where it was 12.85 PE. Let's see. In 2018, the PE went from 8 to 15, which is 9. No, I'm sorry. Which is that 7? Yeah, 7. This is 5. 2019's is 5. 2021 is 13. And 2022 is 10. So let's do between the middle of these. This one was 7, this one was 5, so we'll say 6. So I'm going to take the current PE ratio of 12.85 and add 6. That's 18.85 times 4.06, and that brings us to 76.53. So with my analysis of PE, price earnings ratios, I estimate that this stock can move up from its current price of 53.06 to $76.53 a share if the PE ratio doesn't drop below 12.85 but continues to move up. It's been moving up at this point. Now let's jump over and take a look at whether the Yahoo analysts have an estimate and what they estimated at. Yahoo analysts actually estimated much higher than me. I estimated that it could move up to 76.53 in the next 12 months. The Yahoo analysts, you estimate that it can move up to 121.33 in the next 12 months. I'm not necessarily sure what everything that they consider in their estimation. I just purely consider PE ratios, but I'm not sure of everything that they consider. So having said that, let's go back to our spreadsheet. Now that we've looked at prices that it can currently move to, sorry there. Now that we've looked at prices that it can move to, let's start to look at some of the fundamentals for this company. So, in 2018, RCI Hospitality made $165 million. 2019, $181 million. 2020, they jumped back. Still made money, but they only made $132 million. 2021, they moved forward, even higher than 2019, $195 million. And in 2022, $267 million. Now, they're not a company that's making billions of dollars, but they're a company that's bringing in some pretty decent income, 165 million or 267 million isn't anything to sneeze at, right? So they're bringing in some decent income. Now let's look at their net income or their profit after they pay all of their expenses for that year. What money are they left over with in terms of profit? And just as importantly, what is their profit margin? In other words, what percentage of their overall sales or revenue did they keep in profit? Well, in 2018, out of 165 million, they kept 20 million. That was 12.60% in terms of their profit margin. In 2019, out of 181 million, they kept 20 million. That's 11.21% profit. 2020, they actually didn't keep anything. They lost 6 million. So we're not going to count that year. They made 132 million overall in sales, but after they paid all expenses, they took a loss of 6 million. Let's jump over to 2021. In 2021, they made 195 million and they kept 30 million. That was for a profit of 15.54%, higher than the previous 3 years. And in 2022, they kept 267 million and they made 267 million and they kept 46 million in profit for a profit margin of 17.20%. So actually in 2021 and 2022, not only did they make more money in terms of the overall sales or revenue, but they kept more money in terms of their profit margin, 15% and 17%. Now, let's go down and look at their return on equity or return to the shareholders, right? We look at return on equity. We see 13.62% in 2018, 11.98% in 2019. We're not going to count the COVID year 2020 because they, like we said, they lost their money that year. But 2021, 16.93%, and 2022, 19.04%. So their return on equity, it's not great. It's not up in the 20s or in the 30s, but it's at 13, 11, and then in 21 and 22, 16 and 19, I would say they have a decent return on equity and debt to equity is good, under 200, 115.04 in 2018, 109.30, 109.39% in 2019, 136.98% in 2020, 103.44% in 2021, and 119.53% in 2022. So I would say that they are controlling their debt, which brings us to the balance sheet. And we see from the balance sheet 2020, which is the COVID lockdown year, is the only year where their current liabilities exceed their current assets. Their current assets, things they own, exceeds their current liabilities in every other of the 5 years. And their total assets exceeds their total liabilities, almost doubles them in 4 out of the 5 years. This company does pay a dividend, and we'll see what that dividend is as we go down further. But the most important thing, well, I shouldn't say the most important, but it's important. Whenever I see a company, oh boy, I'm not seeing my scroll bar over on the right, so I'm using the keyboard to move up and down. When I look at a company that gives a dividend, I like to see where they're giving that dividend from as well. Because they may just be borrowing money to pay you your dividend. And why are they borrowing money? Because they want to make sure that you hold on to the stock, and they want to make sure that people who don't own the stock keep buying. And those people may do it because of the dividend, realizing that they're borrowing money just to pay you this dividend. And if they borrow money just to pay you a dividend, what can happen? They may reach the point where they eventually have to stop paying you the dividend. But what I want to see is I want to see them paying you their dividend from their free cash flow. And so we look at this company and we notice in 2018, see that minus symbol in front? They didn't pay you the dividend from the cash flow. So what does that mean? That means they may have borrowed money just to pay you that dividend that year. But because they only had 506,000 in cash flow in 2018. But in 2019, they had 16,466,000 in free cash flow. So they were able to pay you a dividend and still had 15,214,000 after paying you the dividend. In 2020, they had 12 million in free cash flow. They were able to pay you the dividend and still had 10 million. 2022, 33 million in free cash flow they had. They paid you the dividend and still had 32 million. And in 22, they had 51 million in free cash flow. Their free cash flow is growing from year to year, as of lately, I should say. And when they paid you the dividend, they still had 49 million. So they have enough cash flow to pay you a dividend every year. And to be honest, they have enough cash flow to increase that dividend. If we go down, we'll notice that the dividend they give you is small. It's only 0.45%. It's under 1%. Hopefully it'll increase regularly. The last dividend they paid, 0.06 cents. So basically 6 cents for each share of this stock you own. So it's a small dividend. Now this company, they have 9.42 million outstanding shares in the market. And of those 9.42 million outstanding shares, 12.09% is owned by insiders, people who work in the company or are part of the company. 12.09 I would consider a large number for insiders. Usually that number is less than 1, but in this case it's 12.09% of 9.42 million. 44.71% is owned by institutions, large banks and so forth. And we spoke about our dividend. Eric Scott Langan is the chairman, CEO, and president of RCI Hospitality. And he's been there as in those positions since 1999. He is also the president at XTC Cabaret and J.W. Lee Incorporated, and the director at Association of Club Executives. RCI Hospitality Holdings is in the restaurants industry and consumer cyclical sector. Now that we've spoken about the fundamentals of RCI Hospitality Holdings, let's look at the technicals or the candlestick charts. And we notice for this company, the prior week was a slightly positive candle, but it moved up. It came back down by the end of the week, but it still stayed positive. It ended the week slightly above, very slightly, but slightly above where it started. Well, it actually did the reverse this week. It came down throughout the week, then it moved back up by the end of the week, and it ended the week slightly above where it started the week. So it only moved up a little bit. but we see this company, it's been up and down, but this was February of 23. It started a decline. We saw a little hope of it moving up here, but it continued to decline. So I'm not really saying I see great hope that it's going to move up from this time forward, but it's something to look at. If it moves up again, another positive candle this next week, but moves up just a slight bit, then we may want to consider jumping in and seeing if it continues to move up. But at the same time, as we looked at this stock and we looked at the PE ratio, we saw that it still has some room that it can move down. So it may not be ready to pop just yet, but let's keep an eye on it and see what it does. Now let's switch over to 12 months and look at an annual chart on this. And we see it's been moving sort of sideways and moved up, down, moving sideways. We see it moving up in these two candles. Here's 2 years it moved up, 2 years it moved back, and then it really jumped. This would be 22, 21, and 21, in 20, 21, and 22. The stock price really jumped, particularly 21. But in 23, what happened? It dropped. And in 23, not only did it drop, well, actually in 22 it dropped. We'll see a long tail here. The long tail is all the way here. So it pushed all the way, it opened here, it pushed all the way down here, then it reversed. The sellers jumped out and the buyers came in and pushed it all the way up here. But now we're in 2023, and notice a lot of fundamentally sound stocks are down this year. I'm not sure what's going on with the economy or the administration or whatever, but a lot of fundamentally sound and strong stocks are dropping this year. But here we are in 2023, and they dropped. Not only did they drop to where they opened up last year, they continue to drop even further. And if they keep dropping, they soon may be at where it opened up in 23, in 21. So in any event, that's what our yearly candle says. And like we said on the fundamental analysis, the PE can still drop further. But like we said on our weekly chart, we'll take a look and see where it goes. Okay, guys, I'll speak to you in the next video.